Hello, Dave Boucher here. What I'm going to demonstrate today is operating income based off of acquisitions and labor analysis. What you see right here is the operating income, the net service revenue, earning before taxes, so on and so forth for several different companies, and it's broken down by month and quarterly basis. So if I click this plus, what you're going to see is individual each acquisition that we did for the full year, but this VAC was one we were looking into towards the end to see if it was a good acquisition or not. And as you can see, you can change this model that I built is based off of entering data analysis to change it to see different scenarios. So if I want to change this 60, say to less, like say 58,000 million, whatever it stands for, it's also going to change the number down here and also going to change the total the way it's built up. And so each time that you change it or lower or raise this amount, actually it's this one right here, it changes it to modify all these too. Now minimize that back out. The actual VAC acquisition itself, I want to break down that to look and see some of the numbers that we came up with. Now, the initial purchase price is $64.10, includes the net worth itself at 100% cash, but our strike price is 10 cents a share. Now, the options was $36.50, but the earnout purchase price was based off of EBITDA, and it also used 100% cash because it wasn't a stock transaction. So you break that down into what kind of profit we have. We see that 6404 for the first quarter ends up being the first profit. Now that's at a 29% gain also. And then I want to break it down by each month. I have at 1829 is what we have for the month at a 27% increase. So when you want to look at the total for after a 2 to 3 year time period, you want to see what the total gain, or the total percent gain, you'll see it's at 29%, which is still a good profit. It doesn't really gain over time, it remained consistent. Now, one of the big reasons why we were looking into this acquisition is it had a project that was based off of had some profit margin analysis that was based off of different scenarios. This scenario here has a project underrun of 2 million that is identified after year 3, and so it had 2 million savings that would occur evenly in years 4 and 5. And what that means is if you look at this project budget, the 750,000 year 4 and year 5 it ended up only being 50. Well, that's because the project ended up paying for itself, because after year 3 you see it's 42% complete, and then year 4 ends up being 60, which then gives it the $2 million underrun. So after that, the project ends up being towards the second half of its life. So basically, if you look at the cumulative revenues, you also can see it's right here at over 5 million, and then it goes to 8, and goes to 9 in cumulative. But then the annual revenue ends up dropping off. Now, when you look at the variance, you'll see that the variance hits its peak in the cumulative at year 4, but then the annual ends up going from 7 at the most at year 4 at 700,000, then ends up going negative because it's already it's paying for itself. So that that's a good reason why we're looking at that company. Now, other reasons of breaking it up to see other percentage growth, to see what kind we were doing within that year. You see that the quarter, here's the quarter numbers, and here's the year numbers for each sector. So these are just a broad overall sector with the percentage growth for each sector. Now, to break that down, we have the acquisitions. So the acquisitions done within that year also have the percentage growth. And what I like to look at is scrolled over too much, is the percentage growth on second and third year that we were looking at in a forecast. So you can see the acquisitions, some of them are doing bad and some of them are doing really good in growth that we perform it out. It just varied. So then let me go back up to show you something else what that means, because it's also included that VAC acquisition. Is you look at the potential upside. I mean, you can break it down, amortization expenses, but I don't want to get into all that. At an incremental strategy, 100% effort, you have variance numbers for forecasting for each quarter, but then it ends up being it's harder to forecast in the third year forecast. So when you do exit strategy elimination, the numbers are a little bit easier because they're a little bit smaller and closer together. So you end up having a better idea of what you can use for your cost improvement actions and so on. Now, another big area to look into in acquisitions and operating income and so on is the share info, which is the earning per share. Of all the ones that we were looking at in that certain time period, certain area for that year, really only one that we had to really be concerned with right here that had a significant share information. All the other ones were smaller share because they're all pretty much smaller companies for this company that I was working for. Now, moving on, with all this data, they also have to use some type of labor analysis. And within labor, there's tons and tons of data and tons of fields that you have to deal with. So, as you can see here, you got your labor multiplier, labor billing, some of the year labor amount. What I want to show is the profit margin. So, say this profit margin is based off of the total percent of profit. So, say I'm going to change it to see what the total percent of the Z total down here. So I go up and change that December amount and go to the value field settings. So I want to get a better idea of the total amount that's being used based off of the Z score. So I see the percent of total and change that, and that then will change this amount to be a percent of that total, and so you can get a better idea of each individual labor margin that we're using for each individual either employee area or employee themselves, depending on how you're looking at it. So there's your percent of total. Now, what I'm going to do finally to look at those numbers, breaking down into more of a better spreadsheet. You can base it off of EBITDA. Obviously, you have all your different accounting groups and your pivot tables, all the different types of data that you can look at. But what I'm going to look at is the sum of year to date of the actual. So there's the numbers for the actual, but then you look at the average utilization for the year, and it's mostly in the 20s, late 20s, and early 30s. As far as the percent, with your labor multipliers being around 2s. Now this is broken out in each office. Each office has its own little area, or each acquisition, all the way down to the total here at the end. So when you're looking at this total, you see that the numbers are quite large, but you want to look at that on a more understanding or noteworthy basis. So you'd actually have to do an analysis of total report for the year. So if you want to do a sum of the average, this is what you're kind of looking at, is you see that the totals then end up being around 60 or 70% of mainly for the utilization for the year. And then your labor multiplier is a little bit higher, 2.8 to 3, but your billing is very important because that's the total for the year along with your labor profit. Some of your labor profit is something that they usually look at, but what I like is the average breakdown utilization. When you look at each individual breakdown, you can see they vary from 38 to 70% for each employee count. So basically, it is good. It is a good reporting factor that can be done. Thank you. That's the end of this demonstration.